Well, welcome back. Futures are up this morning as we look ahead to more earnings and economic data. We got a pretty good rally underway. Dow Industrial's up 139. The NASDAQ right now up 92. Joining me right now is Generational founder and managing partner and former Raymond James vice chairman, Fred Lane. Fred, good to see you. Thanks so much for being here as we approach Thanksgiving week. What are your expectations for this market going into year end?
Well, I think we're going to continue to have I think good, volatile, choppy performance. I think the market will be trending up. I think it's inevitable that the market always looks forward beyond what's going on in the economy. The economy is a little bit confoundingly strong. I think it will remain. I think the GDP numbers will be okay, but eventually, when we stop looking in the rearview mirror and we kind of look forward, we're going to see that the housing is really depressed and will continue to be depressed. And I think the consumer is going to start pulling in their spending. Savings rates are going down. Credit card balances are going up. It's inevitable that this inflation is going to take its toll. And I think that's ultimately going to show up in the economy. I think the market's already discounted that and is looking forward to those pockets where you can find value despite, I think, what will be persistently high inflation over the next 4 to 5 years. I think it's inevitable that high inflation will be with us and will run ahead of interest rates. Central banks
where are you finding value?
Well, we've always been buyers of growth because let's ignore this value versus growth distinction, because in my view, you can find very valuable companies at low valuations that have good growth prospects, and sometimes traditional growth companies actually present very good value. But without top line and bottom line growth, over time, you're not going to have a growing investment value. So by definition, growth and appreciation in investing go together, in our opinion. However, having said that, we also are looking at the macroeconomic environment. And the macroeconomic environment suggests to us that looking at certain commodities is critical. And actually, one of the ones that we've really focused a lot on is gold. And we've actually owned several of the gold miners. We have a very deep research capability in the gold area. And we think that's one of the great leveraged ways to buy gold. The central banks have been net buyers of gold since 2008. It's been every year they've bought more and more gold. And I think what they realize is that that is the reserve currency. That is a form of reserve currency. Obviously that went away in 1971, but it is the reserve. It is an asset that is pretty solid in terms of maintaining value.
Well, I feel like gold is also a hedge, not necessarily a commodity that you're looking for growth in the commodity as much as you're looking for a hedge to hedge against what could be a disruptive stock market.
Right, but it's also our view that there's substantial appreciation potential in gold. And obviously, that has not been the case over the last decade or so. Actually, it hasn't been really appreciated that much. But I think our view is that there's so much paper gold out there, derivatives, and eventually people are going to say, something, we don't trust the derivatives market. We want to own the physical gold, and that's going to put a squeeze on some of the what I'll call the paper gold, which is a multiple of value versus the actual gold in circulation or available to be in circulation.
And
the replacement rate is about 1% a year.
Go ahead, Adam.
Oh, thanks, Maria. Fred, wonderful to be on with you. I have a question for you specifically. For the first time in about 9 months, I'm actually seeing some of our clients ask about whether this is the time to start putting more capital. Are you seeing that from your clients? I want to know I'm not alone. And if so, what are you telling them?
We're seeing some of that, but the caution is it's incredible, Adam. I have several friends and clients who have eight-figure sitting in cash, maybe because they had a monetization event, they sold a company, they sold a large investment, and they're very cautious about putting the money back to work. And of course, as you know, everybody says that when there's blood in the streets and there's a lot of anxiety and fear, that's the time to be an investor. I don't find that people necessarily do that. We feel very strongly this is the time to put money to work. The values in growth and technology and healthcare are extraordinary in our view. And we also think that inflation is persistent. So what are you going to do? You have to own real assets. And that's equities, and that's property, you have to be careful about property, and that's, frankly, gold and silver and other, real assets that are going to hold value, if not, and hold value and appreciate at greater than the rate of inflation.
Fred, any thoughts on Twitter? A new wave of resignations after Elon Musk gave Twitter employees an ultimatum. Either commit to working long hours at high intensity or leave the company, closing its office building until Monday. Your thoughts on where this stock and company, well, it's private now, but where this company is going?
We owned Twitter, a year and a half or 2 years ago, held it. We was sold. We weren't. We were kind of glad to see that happen. We were a little frustrated by the performance. It's an interesting metric out there, which we had actually looked at. So Meta, as an example, which is now laying off 13% of its workforce, the ratio of sales to employee at Meta was about $1.2 million. The current ratio of sales to employee at Twitter is about $660,000. So I think that speaks to the point that the productivity at Twitter is a lot lower. Now, in each case, those numbers ignore a small sliver of contractors. But I think the numbers speak for themselves. And, I think part of what you're hearing, in today's world, any of us can go and tweet how badly we feel and, how mommy hurt our feelings or something.
Yeah.
But the fact of the matter is, whenever a company is sold, there's always a certain mourning. People don't like change. They like a certain culture.
Yeah.
We went through this at Donaldson, Lufkin, and Jenrette. Credit Suisse bought us, and here it's 22 years later, and we're still getting together and mourning DLJ. Guys, get over it. It was 2 decades ago. Move on. We have to move on in life. So.
I love DLJ. Oh, God. Take me back, Fred.
So did I.
Great to see you this morning, Fred. Thanks so much for weighing in on all of that.
Thank
Fred
you.
Lane, Generational. Thank you, sir.